I always tell people that I trade control for diversification as a passive investor, and I try to get diversified across asset classes, geographies, and operators. And so, um, the problem is that when you give control to somebody, you can't eliminate all the risk. It's impossible. Now, there could be fraud, mismanagement, Ponzi scheme, and also there's like what I call I can name you 20 what I call 1% risks that can happen that have nothing to do with how property is being managed.
You're listening to the Accredited Investors Only podcast, presented by Accredited Life.
Jeremy, welcome to the show. How are you feeling today?
Good. Thanks for having me. I hope this is helpful for all the listeners out there.
Hey, I'm looking forward to a good conversation. I always like to start off with hearing the guest introduce themselves. So please introduce yourself in your own words.
Sure. So my name is Jeremy Roll. I am originally from Montreal, Canada. Moved to the U.S. back in 1998. So I spent about half my life there, half my life here. I'm currently living near Newport Beach in California. I have an MBA from the Wharton School and spent over 10 years in the corporate world. You know, my last couple of corporate jobs were like, last one was Toyota headquarters. The one before that was Disney headquarters, both in LA. And, but on the investing side, I started investing as a credit investor in passive, syndicated opportunities back in 2002. So it's actually next month, it'll be 23 years. But actually been doing it full time since 2007, mid 2007. So I guess that's about 17 and a half years, almost 18 years. Basically I rotated all my money from stocks and bonds into cash flow between 2002 and 2007. And then I left the corporate world in 2007 because of a last strong moment with my manager. So I didn't actually do it with the goal of leaving the corporate. I have enough cash flow to build up to live off of at that point. So I have focused as an accredited investor on very predictable cash flow because I live off the cash flow. So I just want to go to sleep tonight, wake up tomorrow, and not much has changed. That's my primary goal because I live off the cash flow. So I look much more for predictability and stability than upside. So I tend to invest in 80 to 100% occupied, stabilized properties. And sometimes they have value add, sometimes they don't. That's kind of optional. And I invest across many different asset classes, and I'm actually kind of hyper diversified because it's been so long. So I'm in over 60 LLCs actively right now, and I've been over probably 150 to 200 plus over the past 23 years.
Wow. Tax time must be a fun for you, or what?
Oh man, my accountant retired 2 years ago. He practiced, and luckily the person who took it over is still willing to do it. And the biggest problem with that is that I can be assured that I won't get the last K1 until August, or September is even more common. So which kills me, but it is what it is.
Sure. Wow. Wow. There's a lot to unpack there, and I'm looking forward to this interview. I'm sure you will have a lot to share in 20 plus years of LP and accredited investor investing. But first and foremost, I didn't realize you were from Canada originally. So what would you say the big difference is, splitting your life between Canada and the US, and what's kept you here for as long as you've been?
So I'm from a very unique part of Canada, which actually makes a big difference, I think, because I'm from Montreal and I grew up English. And so I was English language first, French second. And the challenge with Montreal is if you're English and you want to be in a workplace, it's going to be English for the rest of your life. And you're just planning on getting jobs and not being an entrepreneur, for example, then you basically half the jobs are completely out the window, and half the jobs posted are going to be in French. And I don't mean listed in French. I mean, you're going to be speaking French all day.
Sure.
It's a tough place, even though it's a big city. It's a tough place to think, oh, I'm going to have stability for the rest of my life, because literally by default, half the jobs available you won't want. And so, I'm just talking starting from the gate. So I didn't want to move to Toronto, which is kind of like a big US city and a very common place. Didn't want to move to Vancouver. So once you remove those two big cities and maybe Calgary, there's nowhere else to go in Canada that's big for like long-term stability. So I decided to go down to the States. And so the States to me was appealing for many reasons, continues to be. For many reasons, haven't gone back there since. I can't ever rule that out, but it's not really at all in the plans at the moment.
What's the real estate environment look like from an investing standpoint? What's the similarities? What's the differences?
Yeah, well, it's interesting because Quebec, where I'm from, actually has a different set of laws, and I'm gonna always blank on so the rest of Canada uses one legal system, and Quebec, literally the province, uses a different legal system. So to the point where if you make an estate plan and you have a trust or whatever in Quebec, if you move to the next province over, it's it's not even recognized. You have to start the whole thing over. So yeah, so it's the same thing with the real estate laws. It's complicated. So and to be honest, like I have a few passive investments in Canada. That's actually where I started investing first, just to dabble.
Okay.
But I am not an expert in the Canadian real estate market, because what I learned through experience was that the exchange rate volatility was a big challenge for me, especially if I'm looking for predictability, and that's not predictable.
Sure.
So I still have some holdings in Canada, but I haven't probably made any new investments in Canada. I'm going to guess since 2009 or 10 or something.
Yeah. I feel like the only ones I ever see advertised is in Vancouver, because I feel that's like right up, kind of past Seattle, right? I mean, so it's just other than that, I feel like I don't really see anything, but I do see a lot of Canadian investors looking for, stuff in the States.
Yeah, and I think you see a lot of Canadian investors looking for stuff in the States, because I think there isn't a lot in Canada to the extent of there's syndications. Like, it's just not, Canada's 1/10 the population of the US, just rough. And so the options are much more limited. And I gotta be honest, anyone looking in Canada to the US, there's all kinds of tax challenges getting the cash flow back to Canada, or you're going to pay double tax on it. So some people actually choose to invest in the US in an NT and leave it here. They can't take it out. Yeah. And so it's actually not so simple for a Canadian just to invest in the US.
Gotcha.
Yeah.
Interesting. So you said you studied at Wharton. I'm a Philadelphia guy. So what brought you there, and what did you learn that you still use today? I'm sure there's a few things, right?
Yeah. So look, when I was applying to schools in the States, what I did was I just basically took a shot at the top schools. So I looked at the rankings and I applied to basically the top 12 that I thought made sense. I got, I think, 4 of them, one of which was Wharton. And the truth being is that I really liked a lot of what Wharton had to offer, but I also thought it was going to be the best branding for me and the rest of my network for me, because the challenge I had is actually I had a few jobs before I moved to the US, but a couple of them were very large companies, like government-owned companies, but nobody in the US would have ever heard of them,
Okay.
And so I needed to get US branding, and that Wharton MBA was a huge help. And when I
It doesn't get much better than that.
yeah, so I think it's been especially helpful for someone who's foreign, right? Who's like not able to leverage as much of their CV or resume, I think. And so and so I mean, obviously learned a ton. It was an intense 2 years of learning. The alumni network has been fantastic. Yeah, so it's just been a huge help in my life in many ways.
Did you become an Eagles fan while you were here?
Well,
Especially we're doing this in January, or so.
That's right. No, so what's funny is that I'm a hockey fan because I grew up with my dad.
Yeah.
And we in Canada didn't grow up with much baseball and hardly any football, really. We had a football league, but it was not like the NFL. So
Sure.
I've never really been into football. I don't mind it at all. But I don't follow. I actually pay every year to get a subscription so I can watch the Canadians from here, and I watch every game. So I'm still a hockey guy. Now the Eagles, as you probably know, their stadium was not that far from our campus.
Exactly.
Yeah, and but I've heard the stories. I never went to a game. I probably should have gone to a game, but never went to a game.
It's an experience without a doubt, especially playoff time. It's an energy, and it's definitely an experience. The city loves sports, especially the Eagles and the Phillies. There's each team has its own real core followers. But like, everybody loves the Eagles. Everybody loves the Phillies. Then when you get to like the Flyers, Sixers, if they're winning, they don't win the same way that the Eagles and the Phillies do. But I thought that would be a funny question. But so from Wharton, you went into corporate America, like you said. It sounds like you achieved what you wanted. You got that brand recognition, and I'm sure that opened some doors. So what field were you in? I don't know if I missed that.
So, and I was in corporate Canada before I left. Right, so I had 3 years in corporate Canada. Then I got into corporate America after the MBA. I was mostly focused in marketing, and at the end, before I got out of the corporate, I did a little bit of finance, but marketing was my main focus.
Gotcha. Okay. And then, so how did you come upon real estate investing? Did you ever do the active side, or was it just strictly, especially with corporate America? I got to think, the passive made a little bit more sense for your timing. And
way too busy to do the active side. Especially my job at Disney was for 4 years was crazy busy, but The reason why I actually got into all this is it was actually a response to the dot-com crash for anyone who's old enough to remember that year. So I'm the fact that watching the stock market go up and down 30% in a year, not the right fit for me. Not knowing where my long-term retirement account would be in 10, 20, 30, 40 years, not the right fit for me. So what appealed to me on the real estate side and on cash flow focus within the real estate side was that predictability. It was knowing that if I went into a deal that was 95% occupied and it was managed well in a good location with strong demand and good, and good, migration to the area and good jobs, that would probably continue, and I'd probably have somewhat predictable cash flow, not perfectly predictable, but somewhat predictable. That's what was really appealing to me. The tax benefits were kind of a nice plus that honestly, when I first started, I didn't even fully understand the benefits of that, but which I've come to really learn, and it's made a big difference. But it was really that predictable cash flow compared to the lack of predictability in a more, I would consider, more volatile stock market. And so that's what really was appealing to me. And it was really in response to the dot-com crash.
Now, was that always the case? Because I feel like when I'm working with my investors and having the conversations, trying to understand what their goals are and things like that, it's diverse. Sometimes there's people that want the cash flow, and I have a lot of people that are in your situation, full-time investors. They're living off the cash flow. They need to have that cash flow. And then there's others that are supplementing W-2 jobs, and so it's not as important. They're looking for upside. And then there's the people that tell you they want a certain amount of risk, profile or a certain amount of thing. And then the next thing you know, they're in a development deal or something like that. You just think, well, that's not going to help with the cash flow, or, that's probably a little bit more risk you're taking on, but it's sexy and it brings people in. Were you always very dialed in on the cash flow, or have you dabbled in other areas and other, strategies and things like that beyond what you're saying with, the almost fully occupied 80% plus, that kind of thing?
Yeah, so I've never done a development deal. I've been tempted a couple of times, like very close, but I never did it. I've never done a crazy value add, like low like 20, 30, 40% occupancy. The closest I've come is mobile home parks, which tend to have a lower expense ratio than most other asset classes, if not all other asset classes, mind you, except for like a single tenant triple net lease deal. They, you can get into one of those at 70% occupied, end up with still with a very good break even occupancy rate, and get the value add upside as well. So it's kind of, you get the best of both worlds. So I've done something like that. Even then, I prefer to be at 80 starting point, whereas with the multifamily deal, I prefer to be at 90 plus starting point, for example. Right.
Gotcha.
So it does depend on the asset class, but I've never done anything really risky, or at least higher risk on the real estate side. I have dabbled in some startups, and I've been fortunate to do well in a couple of them. And but when I do those, I actually do the exact opposite, which is if I'm going to do them, I always go for the early first round, lowest valuation, and only go into something I think that can get to very big, so that I'm really swinging for a home run. Otherwise, I'd rather just take the more predictable cash flow. But that's a very small percentage. I don't do that. I don't look for startups. I only make bets on people I know really well, who I also think I kind of agree with the business plan and I understand it and everything else. So I'm in a handful of those. But outside of those, that's not what you're talking about. I've never done anything, higher risk on the real estate side.
On the real estate side. Well, it's funny because that was going to be one of my questions. If you had a certain percentage of the portfolio that you were, kind of looking for that longer term equity, growth or that kind of thing, and wow, you're talking about going into, you really span the spectrum there. If we went to the other side, which is pretty cool, and maybe something to talk about. But tell me, on the real estate side, so is it mainly multifamily in order to achieve that strategy? Has it been mainly multifamily? Because I would think triple net, industrial, medical office, retail, like some of that could certainly achieve some of the other criteria that you put forth there.
Yeah, first of all, I've done some industrial, but the challenge I have with industrial is that I am not comfortable with the single tenant risk. I was like
Sure.
across tenants. So I never done a single tenant deal that I could. Well, that's not true. I did one in Canada, but it was very unique. It was at an airport. It was like the equivalent of FedEx, and they just weren't going anywhere. I mean, that was their facility at the airport, an international airport.
Yeah.
So short of that, I haven't done any single tenant triple net deals that I can recall. Medical office, I've been tempted to do some, but I've stayed away from office since 2015, which is when so I always try to think 10 years out. And at that point, with the internet becoming more and more, widespread and higher speed, it became less predictable to me where office demand would be in 10 years. Nothing to do with work from home, even at that point, because the pandemic had happened. Just more like I'm trying to figure out if I go for a deal that's got a 10-year fixed rate loan, what's that going to look like? Wasn't clear. Same thing with retail at that point. I got concerned about retail. And this is all the internet kind of growing at that point. So I my top asset classes for predictability are mobile home parks, apartments, and self-storage. Now, self-storage has become a little more challenging in the past years, but generally speaking, in a more stabilized market in the right location, because location is very important, that has a lot of tenant diversification and stuff, especially in a strong demand market. Every other asset class aside from those three, I can kind of, whether it's because I can't see 10 years out or because of some other factor, I'm kind of like consider like kind of a B tier asset class for me. I'm invested in many different asset classes, but if you ask me what I'm looking for actively today, it would probably be those three. Well, not today, coming up soon, which we can get into, but I'm on the sidelines right now. But those are the ones that I picture myself doing the most of over the next 10 years.
Gotcha. And now, does the occupancy change for the self storage? Because they run, their occupancy rates run higher than what a multifamily would, right?
Well, actually, I would argue that if you're the optimal occupancy that I have found in self storage is 88 to 92%. And what I mean by that, is that because there's so much churn, that if you get let's say I'm looking at a self storage deal that's 99% occupied, something is wrong, literally. And with that,
they're not charging off, right?
They're just either no churn, and I need to figure out why, or maybe not wrong but unique, or more importantly, they're not charging enough, right? They're optimizing the revenue, because if you optimize revenue, you're typically between 88 and 92% occupied. So maybe the operator is sophisticated enough to actually use dynamic pricing and actually optimize revenue. So so each asset class is different, to your point.
Gotcha. So, and how has that evolved over the years? So 20 years ago, what were you looking at versus 10 years ago versus today? And then I'm curious to, some of the data and some of the kind of research and, those types of things that are leading your decisions. I think that'd be very helpful.
Yeah, I'll explain to you kind of how I've worked in this past cycle, and then, how I got to these three asset classes. So from 2002 to 2008 or 9, that was a learning period for me. And I was just trying different asset classes and stuff. So I was in a whole bunch of them. From 2009 to 2016, I started off in 2009 with the full price reset, saying to myself, okay, I'm open to any asset class at this point. I see we have a lot of runway left. It's a new economic cycle. So I was basically open to anything that could make sense from a tenant diversification look. They had to check a lot of boxes, but I was open to everything except for hotels. I can never get comfortable with hotels because, a lot of them have 1 or 2 nights churn. And so predictability of income to me is just really tough. And it's also more susceptible to a downturn than some other, like in terms of average daily rate, is more susceptible in a downturn compared to some other asset classes. Yeah. So what I did was between 09 and 13, I invested in pretty much anything that made sense. I'm still very picky, but I considered all asset classes. At 2013, I actually dropped off apartments. And the reason why is because apartments to me were really, really overpriced, because in 2009, we had all these housing foreclosures. All investors knew that people are going to need a place to live. And so apartments got a lot of demand, and then they got bought up. So then once the cap rates got too low, I kind of dropped apartments except for unique deals. I've done a lot of apartment deals since, but they've all been unique. They've had to have some unique component to them. And I kept going. And every asset class I dropped off as it got more expensive below a certain threshold of cap rate, depending on the asset class. The last one was mobile home parks in 2016. As of 2017, I played very defensive. I was guessing a recession was coming up in 19 or 20. I believe we would have had a recession in 2020 based on the inverted yield curve had we not had the pandemic. So I actually was lobbying my sponsors to sell. I was in over 30 sales between 17 and 20. And ever since, I've been kind of holding tight, except for really unique situations, because in my opinion, all the stimulus money that got printed has post the recession that I think is actually now has a high probability of coming up in the next 12 months. And so I'm actually at this point in time, at the beginning of 2025, when we're recording this, the most firmly on the sidelines that I've been since probably 2007 or 8. And so that's kind of how I've played out the cycle. So I kind of drop off the asset classes as they get too expensive. Then I just sit tight, except for unique situations. And having learned about all the different asset classes and tried them, those three asset classes to me appear to be the most predictable. We can get into each one and why, but and that's why I'm ending up focusing on those three for the next decade as A tier. It's not that I won't consider the B tier. It's just those are going to be the A tier.
And what events are you looking for that would pull you off the sidelines and in?
Yep.
And I'm sure maybe it's a little different in each, but probably some similarities in each.
Yeah. I need kind of in this order two things to happen. The domino of whether or not we have a recession needs to fall either way. I need to kind of confirm it or not, and be convinced that we won't have one. And then after that,
What would do that before? Because I feel like there's so much mixed reviews. You know what I mean? Over the last couple of years, you hear so many people saying we're in one, we're not in one. It's like, oh my God. I mean, in your mind, what would do that? What would assure that for you?
what would assure that we won't have one?
Either way, and I mean that we either we're not having one or we are having one. Like, what are the indicators that you need to see?
Yeah. So basically, what will assure me that we're not having one is if we go maybe 18 to 24 months out of the flattening of the yield curve, so where it's no longer inverted, which I think now the clock started ticking in November. Okay. So I think it was November. So so there's still some time to see, but probability wise, almost every time that we get this steepening of the yield curve and it uninverts, we basically end up in a recession almost every time. So the probability is very high from that perspective. I just need to see what happens. And then if you ask me for one data point that would, so as far as if we have a recession, I mean, that'll just be in the media. So that'll be easy to follow. It'll actually seem consumer sentiment, eventually lead to stock market crash. That's just the recession playbook, right? That's what the probability is of what you expect to happen if we were to have a recession. If you ask me the one thing that would make me jump back in, once I've confirmed either of those, it would actually be positive leverage. And one thing, so I didn't invest in any of the floating rate bridge loan apartment deals in the past few years. And one of the main reasons is because we had negative leverage. And also I invest in fixed rate, longer term loans for more predictability. But the negative leverage to me was the real sign that things are just very expensive. And frankly, that's a sign to me that they're still not fully adjusted. We've a lot of adjustment in price, but in my opinion, a lot of deals are still negative leverage I've been seeing. I've seen some positive leverage, but often those are like tertiary market, C class, all kinds of stuff. Sure. I need to see kind of a B plus or A minus property in an A minus or B market that is positive leverage by 100 basis points or more on a regular market rate deal, not a tax abated deal or anything that's unique. And then if that becomes kind of the market situation, I'll be pretty much jumping off the sidelines at that point. Because to me, I just need the risk premium of investing, especially compared to treasuries. So
yeah, no, that makes a lot of sense. Interesting. So, God, there's a lot to unpack there. But maybe we'll shift to operators. So you're that's a big part, obviously, right, of the investing and as a passive investor. So what is it that you look for in an operator? And then just to plant the seed, I'm going to want to talk about what is it specifically in the deal, so how the deal is structured, all that kind of stuff. But I'm curious to, what is it that, an operator, you say, okay, I trust this person to give them my money, or I don't.
Yeah. So it's a good question, and it's become a lot more complicated. And what I mean by that is, look, I'm a very conservative person. You probably picked that up. And the challenge for me at this point is that I would almost say that the less deals someone did between 2018 and 2024, the more likely I am to invest with them. Problem with that is that it's very hard to find sponsors who truly sat. I actually know a couple, but it's very hard to find someone who truly sat in the sidelines. Sure. Unless they did something unique that I think that I agree with at that time. Because I fundamentally don't necessarily agree with the business plans that happened in the past years where I didn't invest in them. And so I don't see myself ever investing with an operator who did a ton of volume because we're just not on the same page. I'm not saying they're right or wrong. It's just that I need to be aligned with the sponsor, right? Sure. So it's going to be very hard for me to find sponsors to invest with because that's kind of a rare situation at this point. That being said,
especially when if they're full time, that's how they make money. They have to keep they're doing it, that kind of thing.
Yeah, but there's been some unique situations. I'll give you an example. I'm investing with a multifamily sponsor since 2013, and I did regular market rate deals with them until 2017, and then they said, this is too expensive now. and they shift it to only low-income housing tax credit and then tax abated deals. I've
Yeah.
still done a ton of those with them because those to me were a defensive play going into a recession, which is why they switched them.
Mhm.
And they also created a lot of positive leverage. So it's not like I'm not investing those, but with that sponsor is very unique, and I'll continue to invest with that sponsor. Did a lot of volume in that time, but they did the right kind of volume that aligned with me. So
Mhm.
I'm continuing to invest with them now, and then if they revert to market rate deals, I'll do those too when there's positive leverage, right?
Yeah.
But so there are some exceptions. It's just the problem is that the pie is going to be very small for me. I'm going to be honest. If I'm trying to be really careful, so that's what's become much more complicated. Generally speaking, I can tell you that I'm looking for a sponsor who is conservative like me, tends to underpromise and overdeliver using very conservative numbers versus overpromise, use big numbers that attract investors, but that are kind of setting themselves up to potentially underperform because they're already starting at a high place.
Mhm.
I want someone who's very experienced in that one asset class. I tend not to invest with sponsors who focus on more than one, at max two asset classes, prefer one. So they're really focused.
Yeah.
I definitely want someone who's had a decent amount of experience in terms of volume of deals done. And I prefer in-house property management for the most part. It's not a firm rule. Then we can get into like markets and types of assets and occupancy and everything else. But that's the high level. The problem is now I have to add in a layer of what did the sponsor do for the past 4 or 5 years? Was that what I'm looking for? Or do they have any challenges they're dealing with that I don't want them to be distracted by? And now the list starts to really go down.
Sure.
You know?
Yeah. Well, what's
So-
your take? I feel like a lot of multifamily sponsors, especially that went towards the sidelines because it was harder to find deals that penciled out and that kind of thing, went into the education space. What's your take on that? You know, I see a lot of sponsors that they have their courses and their masterminds and things like
Yeah.
that. Very curious to hear your thoughts on that.
I am very anti-sales pitch as a person, and not even to do with real estate. Just even if I go into a car dealer, like it really is a pet peeve. And so, I have a big problem with someone who's pitching things unless I know it's a really good course. And I tell you one thing I have learned over 23 years is that there's often a direct inverse correlation between the cost of a course and the value that it brings. In other words, some of the best courses I've seen are some of the cheapest courses. I don't mean zero was $100, $200. I've seen $2,000 courses, but I've also seen 10 or 20 or $30,000 courses or more.
Wow. Yeah.
And I
Is-
tend to find that those tend to have a lower probability of being really good. I'm just generalizing, right?
Sure.
But generally speaking, I don't like the idea at all because I'm just anti-sales pitch. But there are going to be the odd ones out there that are good. Before you spend any money on them, make sure you ask around. You want to talk to people who've taken it or, what people have heard. Very important. You could be wasting some money for sure.
Yeah, yeah. It's always one of those things where I just see it, and I don't know. It just for me, from an investor, from when I put my investor hat on, for who I'd want to invest passively, it's not much of a turn on. But but it doesn't mean it's not a complete game over either. Yeah, you know what I mean. Same with like social media. I mean, that's one of those things that's a necessary evil. I'm sure a lot of people don't necessarily love having to do a ton of posting and all that kind of stuff and utilizing AI or whatever they do, to create these massive amounts of LinkedIn posts and things like that. And I'm curious a lot of times I think to myself, how the heck does that person spend as much time on these forums and these social media sites as they do? And I'm sure in reality, it's not them all the time. It's usually they're utilizing AI, or they're utilizing virtual assistants and things like that. But I'm curious to somebody like yourself when you see that, somebody's on there, they're posting every day, multiple times a day, they're interacting with people and all. Don't you think to yourself, like, when are they working in their business? What are they doing? What all the things you do when you operate a real estate fund or syndication or whatever it is?
Yeah, look, when I think back to my favorite sponsors, literally not one of them does that. And that being said, I am very prejudiced again, to me, it's all sales pitch and marketing. So I respect the fact that social media has become an important way for people to market themselves.
Yeah.
But I will say there's a big difference between some of the way, for example, LinkedIn is used in other ways, right? Some of it, just every post they do is like a bit of an ad, while other people are just help people and add value. And I tend to lean towards the latter. And by the way, I get very turned off when I see a literal advertisement on my phone from a sponsor just broadcasting a deal, mass.
Yeah.
That definitely bothers me for a couple of reasons. But again, I'm prejudiced, so it's very subjective. I don't want to necessarily say it's a right or wrong. I just have trouble with it myself.
Yeah. So when you're, are you always looking for new sponsors? It sounds like you are. You know what I mean? Yeah.
I'll
So
look for good sponsors, but I will be honest. I'm last year and this year right now, I'm very tight on the sidelines unless there's something really unique. So I will look at deals that people send to me and talk to new sponsors, but I'm very closed-minded to begin with, which is obviously not a good starting point. And I'm waiting, and eventually that's going to do a 180, right?
Mhm.
But we're not there yet for me personally,
Yeah.
anyway.
But would it be worth it to, at this now's a good time to at least start the relationship, right? And have the conversations and things like that. Or, I mean, you're more of the deal. It sounds like the deal kind of starts the conversation more so than the sponsor. Yeah.
Yeah, and it could happen the other way around too. So it's funny because um, to me, let's say a conference in the last 2 years, I was hesitant to go network at them with sponsors because I think that any sponsor is spending a lot of time at these conferences currently actively acquiring, right? That's the challenge, right? So that's why I'm afraid to go to events even now. I typically don't go to events. Like I do a lot of like speaking and panelists, where I'm a panelist at some of these. So I often don't go to them unless I'm doing that to begin with. But even at those, I don't like networking at this time with with sponsors that are there in general. Um, and yes, you can try to get ahead of the curve, but I feel like most of the sponsors who are not doing much right now aren't going to those right now because they're not productive for them, you know? So I'm waiting. I'm waiting. The one good thing about real estate compared to the stock market is it moves very slowly. I'd rather be a little than a little early because I feel like that's not going to hurt me. And so I guess what I'm trying to say is I don't feel like I'm going to miss the boat if I don't start the proactive approach now. I don't mind waiting till deals appear and now I start to evaluate them and meet new sponsors.
Yeah, yeah, and like you said, it's not your first day at the rodeo, and you have a pretty clear criteria, things that can be very easily assessed pretty quickly. Yeah, and I think
Yes.
that's very important. How would you say? What would you say to kind of the person I was telling you about earlier? That's like, they don't know what they want. You know what I mean? Like they're kind of here, they're there. I think the I think it's probably one of those things that a lot of people have challenges with, not only in business, and in their investing, but probably in their personal life as well, is that just clarity of vision and goal and, where you're steering the ship. And then, so what would your suggestion be for somebody who's like looking at, how to get started, and how to decide what investments to make that are going to align with their goals and things like that.
Yeah. So the first thing I'll say is over the years, I've seen, unfortunately, a whole number of people with kind of analysis paralysis who I saw at meetings for years in person, but they never actually took the dip. But they were, and to their credit, one time I'd see them at a self-storage presentation, then I'd see multifamily, then I'd see mobile home parks. They're trying to learn, but I think they were overwhelmed.
Yeah.
And so my suggestion for someone who's new is the following. Most people have at least one asset class they can really relate to. So for a lot of people, it might be apartments because they lived in apartments, but let's just take a more easy example to explain. So let's say you grew up in a mobile home park, okay, and you understand them and how they work. I would start with mobile home parks because you understand them better than most people, and it would be the easiest thing for you to learn. I would focus on that one asset class, learn it, learn the basics, learn the underwriting, learn the major factors that you want to look at in terms of evaluating a deal, especially numerically. Try a few. And then the cool thing about most of the asset classes is that you can take, I would say 80 or 90% of the basics, revenue, expenses. A lot of them overlap and are like similar and they kind of transfer from one asset class to another. And then each one has its own tweaks, right? So with self-storage, we talked about occupancy rate you have to pay attention to. Instead of 100 plus unit apartments, I look at 300 plus self-storage, preferably 800 plus, just in terms of diversification, right? So there are these differences, right? But you could take the core foundation you learned from looking at those mobile home parks and transfer them. So I would start with one asset class, just focus on that, but start with the one you understand best. And a lot of people start with apartments, in my opinion, because both they understand them well because they've lived in them and because they're the easiest to find, highest volume. So that's a very common one for people to start with. And to be fair, like the more deals they can look at, the more they're going to learn and the easier it's going to be for them to find one. So that it isn't a pretty good idea in general. But that's how I would recommend someone start versus trying to figure out which asset class to start with. Start with the one that's most comfortable to you to begin with.
Yeah, that's great advice. And probably the same advice you give to somebody who's actively looking to invest, not as an LP, but on the GP side and all. You know what I mean? So start with what you know. and work from there. And I love what you're saying, how there's crisscross, there's things that that you've learned, that from this space, that are going to translate over. And if it's not 100%, it at least is a foundation for you to work off of, and that kind of thing.
Yep.
So now let's talk about the deal now. So is there, what are you looking for in a deal, with how it's structured? How much do you want to see GP skin in the game? Are you looking for 80-20, 70-30? What kind of pref, what kind of, structure in return of capital to the investor? I mean, I had somebody on the show recently that said they'd never invest in a fund that, didn't return capital first, before the split came in. And I thought, you must not invest in a lot of deals like that. That's like, I could see like a large, institutional, pension funds, endowments maybe being structured like that, but definitely not the average thing you're going to see for accredited investors, that kind of thing. So I'm curious to how you look at that. Is there certain criteria, and then how you relate it to the individual deal, because it's like, there's what's best for the deal, what's best for you, all that kind of stuff. So let's talk about that.
Yeah. So look, this is a very subjective topic, because I know people out there who, for example, may put like a little firm line in the sand and say, look, if someone's not co-investing 10% of the equity, then I'm not going to invest. Where I don't have that rule, because it's just subjective. So, so basically, on a co-invest, I prefer to see 5 to 10%. Is it mandatory? Not necessarily, but depends on the size of the sponsor. So, for example, I've invested with one of the top 20 self-storage sponsors in the US. They have over 100 properties. Do I expect them to have the net worth to go 10% on every single property? For example, I think that's unrealistic, right?
Yeah.
And then the worst part is, sometimes when that's a requirement, that 10% can come from a separate entity that they're raising them into Koji, sure, like, or to like, bring on LPs in the GP if entity is making up the 10% is not even theirs. So
Yeah.
that's not a hard and fast rule for me. As far as general high level, so to be fair, my criteria resets at the beginning of a cycle, and I think we're going to be having a cycle reset shortly. So I'm waiting to see where cap rates land and where year one cash flow lands, because I like pegging the preferred return at or near a realistic first year's cash flow for what I target. Probably going to be 7 or 8% preferred return I'm going to target in general as a minimum, but I don't know yet. And then as far as the split goes, it depends on how much work has to be done, how experienced the sponsor is, and how difficult the asset class is, et cetera, et cetera. There's a lot of factors that go into it. What I'll say is that I have invested in 50-50 deals before that were heavy, value add, relatively speaking, like a mobile home park that's 70% occupied that they bring in. It's a big mobile home park that they bring in, 100 homes or whatever it is. That's a lot of work.
Mm-hmm.
But generally speaking, I strongly prefer to be in the 75-25 to 60-40 range. I get concerned in 80-20 and 90-10. I see those, but often those either from brand new sponsors who have to do that. I just get concerned the sponsor won't make enough money. I want to make sure that the sponsor is aligned with investors and actually is incentivized at the same time.
Yeah.
I understand what you're saying about the return of capital versus profit split above the pref. I don't have a requirement like that. It's rare that I see, because some of them are worded, the operating agreements, that anything above the pref is still returned to investors, but it pays down the capital balance of investors' accounts. And I see the sponsor who prefers to do that, so that they're kind of eating away at the capital balance quickly, and then eventually
exactly. Yeah. And that could be a little bit of a drawback, depending on what your goals are and your risk appetite and all that.
Yeah. And actually, so I don't have a hard rule for that, because I actually kind of like the idea that I have all my equity in until the end. I don't mind if they're getting a bit of a profit split if they're performing, right? As long as it's the correct profit split. One thing I have a hard rule against is I've seen deals go like beyond 50-50. You don't see that now because of market conditions, but 3, 4, 5 years ago, I've seen funds that were like doing 40-60. And I've seen them not be able to raise money and they revert to 60-40. I'm like, I'll never invest with that sponsor ever, because we're not philosophically on the same page. It doesn't matter if they switch it to 90-10. It doesn't, right?
Yeah.
So I definitely stay away from that. And 50-50 is a very high bar for me. It'd have to be like a top 20 sponsor who's doing a ton of work, who's doing a hard asset class, and I really want to invest with them, and I have a good, maybe even track record with them, whatever it is. Yeah, but I'm not like, I don't believe in squeezing out, and I do the same thing if I'm negotiating something in life. Like, I don't believe in squeezing out every penny. I like it to be a win-win. I think that's important, because you're giving control to somebody else, and I want to make sure that that person feels like they're motivated to really operate a deal well.
Yeah, I think that is great advice, because not everybody certainly feels that way. And I mean,
Right.
it's very important to understand things from the operator standpoint and how they're putting food on the table, how they're surviving along the way of the deal. And just, I think you hit the nail on the head with the word alignment. There needs to be an alignment, and that's going to lead to success in the long run. Talk to me about deals that you've had that have gone south. I'm assuming in 20 years there's been a few, and what did you learn from those, and what were kind of the things that you would say for people to look out for in that sense?
Yeah. So there's two salient examples for me. Um, Both of them were real estate, so I'll use those. Um, One of them, so I always tell people that I trade control for diversification as a passive investor,
Mm.
and I try to get diversified across asset classes, geographies, and operators. And so, um, the problem is that when you give control to somebody, you can't eliminate all the risk. It's impossible. Now, there could be fraud, mismanagement, Ponzi scheme, and also there's like what I call I can name you 20 what I call 1% risks that can happen that have nothing to do with how the property is being managed. So, as an example, um, property gets, I'm going to give you a real life example, actually. I was only in one foreclosure ever so far. And that happened in 2012. It actually was completely unrelated to the last downturn. So, 303 unit student housing apartment building, literally first property across from State University campus, fantastic location, big,
Huh.
big school. And it's like, call it 97 to 100% occupied, right? So the spring comes around and everybody gets a letter from the city, all the tenants and the owners. And it says, hey, we're closing the bridge to campus this summer for repairs. But don't worry, it'll be open in time for like the school season. No worries, right? Because it was a cold climate. And so what happened is that people got worried and they moved. And they basically, the occupancy dropped from 100% to 65%,
Mm. Wow.
low break even. Now,
Wow.
that was one domino, right? But the next domino was that the loan was actually due that fall.
Wow.
Okay. And then the third domino was that despite all the previous years of 97 to 100% occupied, the bank wanted the property and they wouldn't extend the loan for a year because they wanted the property. Otherwise, they would have looked at it historically and say, yeah, we'll work with you. No problem.
Sure.
So, I consider like when you go into a deal that's highly occupied, you have to have multiple dominoes fall. Just like a new airplane does not crash because it has redundant systems and all those things unless four things go wrong.
Yeah.
Right. Five things. That's what has to happen in a highly occupied, stabilized, well-managed property. But that happened. So that's a real life
Yeah.
story.
Yeah.
And the reality is that, and by the way, the crazy part of that story is that the sponsor felt really bad and actually owned most of the property themselves without very many investors, and actually ended up transferring everyone's interest a year later into another property first right across from a State University campus. They own in another state that I'm still in today and cash flowing. Didn't even my only foreclosure. I didn't even lose equity in my only foreclosure. So, which was interesting because I made a bet on that person, they chose to do that. They can afford to do that, right?
Sure.
Which is not obvious and not legally required.
Sure.
A couple of important learnings there. One is that, like, a property can burn down. You can fight with insurance for 4 years. You lose. You spent money trying to do that. Now you have land. During that time, the land's become very worthless because it's sitting there. So there's so many things that can happen. So you have to diversify. So that's learning number one, which is the most important one. Learning number two is that you have to acknowledge that you're going into something that has all these 1% risks, even if something is mismanaged or worse. That's why diversification is so important. You cannot avoid them. The risks are always there. Number three is that in that particular case, the reason why I didn't lose equity is because I made a bet on a person who was willing to come up to the plate and actually help investors. Not only were they capable of it, so I now favor sponsors who are wealthier because they can choose to help fix problems,
Sure.
sometimes avoiding cash calls and just putting their own money in, right?
Yeah.
But also forget that they had the money. Legally, they didn't have to do it. So they had to have the mindset and the mentality that they wanted to do it,
Yeah.
right? So I'm not saying I have hard, steadfast rules of only investing with those types of people, but they're good lessons to see and learn, right? The other quick one is that I invested in a portfolio of homes in Memphis that were being purchased, rehabbed, and flipped in 2012, roughly. They're meant to be 5-year holds, but purchased, rehabbed, and tenanted and then sold within 5 years, but cash flowing for 5 years. So there were three partners. Two of them I got to know really well because they're the real operators with a history. One of them was a guy who was like the IT back office guy. I didn't really pay that much attention to him in the due diligence because he wasn't the active partner. There was a partner dispute. The two guys who were the active operators left and left everything into the hands of this inexperienced IT backhouse guy who also turned out to be a little sketchy. And so he started mismanaging everything. And I actually stepped in and helped to negotiate switching to new manager in exchange for releasing a release of liability with that sponsor. So what ended up happening is that the new sponsor came in, finished all the rehabs, got him tenanted, sold them. We ended up, I'm going to say, breaking even. We were about a loss of 4% or something. Okay.
Wow.
Not a bad outcome, not a good outcome when you lose money, but not a bad outcome in the circumstances. And yeah, so the lesson there for me was, you got to take a look at every single managing member very carefully, even if a managing member seems much more benign than others and less key at a time, because things can change. But again, I want to go back to the fact that, multiple dominoes have to fall. You have to have a manager dispute, which doesn't often happen. You have to have the wrong guys walk away. Then you have to have that guy who happens to not have real estate experience and who also is sketchy. 4 dominoes, right? So again, this is why diversification is so important. And this is just, if you're going to go into the space, you have to be willing to take on and kind of acknowledge that these risks exist and know that they can happen. And there are some you just cannot do much about.
Sure. It's a very adult way of looking at it, right? I mean, and just that's an important thing to remember, that there's just certain things that are out of your control. Whether you're, and it's like you said, whether you're an active investor, there's certain things out of your control, like that student housing operator didn't have control over the bridge, and so it's on both sides of the spectrum. You cannot get around just life, and the things that happen, right?
I want to say, by the way, unusually in that foreclosure that happened, not only was the sponsor the main investor in the deal, so they lost a lot of money in that equity, but then they transfer everyone else's equity from their own equity into another deal. So they lost a ton of money themselves on the backs of investors, which was very unusual and very nice, and I still appreciate today.
Yeah,
so
that's amazing. Well, God, there's so much to unpack here, and I could talk to you all day. I think you're a great guest for this show, where we have accredited investors who are listening that are, either very active, who I think now more than ever need to re-examine what they're doing, which you have done, and given some great advice on, what you're looking for to get back into the market and that kind of thing. But also too, just a lot of information for people who are accredited but haven't, gotten out of the market yet, and they're still, very active on that side of investing and looking to, get into alternative investing in real estate. But like you said, anybody who's gone to events knows there's the people that keep going but haven't done anything quite yet, right? So, and sometimes that's a good thing. I talked to somebody the other day who wanted to get into boutique hotels from an operational standpoint, and I was saying sometimes it's good that your goals don't work out, when you thought they were going to work out, right? Yeah. Sometimes the universe is helping. What's your thoughts on that?
Yeah, I know it's a good point, and it's actually a really good point. And I want to clarify something, because the last thing I want to do is make it sound like, oh, you should just focus on one asset class, just do it, right? I think be very picky. And in fact, I want to stress something. The number one frustration I have in talking to new people who happen to be in a very good capital position is, and I've had this call many times in the past. Somebody calls me and say, hey, I just sold my business. It did very well. I had a big exit. I need cash flow, right? And they're just dying to find something. And the first thing I say to them is, well, hold on a second.
Yeah.
You have the cash. Yeah. But did you take a step back, analyze the macroeconomic situation in the economy, and decide this is a good time to deploy the cash?
Yeah.
Right. And often most people have not. And that's what really kills me, because there are many times where it doesn't make sense to do anything. Like, well, I'm not doing anything right now. So you have to make that own decision for yourself. And the last thing I want is somebody thinking, oh, focus wise, I just try a bunch of go and do it. Stop waiting. Because sometimes waiting makes the most sense. We're talking about people where the timing is right, but then they're getting, analysis paralysis or not able to really move forward at all. So I just want to clarify that. It's an important point.
That's a really important point. Really good advice. And it's just, sometimes you just have to kind of breathe. And I talk about it a lot on this podcast, and kind of the community behind it, and like the stages of the community and stuff like that. It's you have to build a really strong foundation. And as accredited investors and people who are passionate and excited and have grown wealth in other areas, you just want to just full steam ahead, and there's a time and a place for that, but there's also a time and a place for taking a breath, slowing down, looking at, like you said, the macros and things like that, and what's going on, and just taking that time to analyze, do your due diligence and your research, and from there, that's just going to help drive smarter decisions, and so you're ready to move full steam ahead when the environment's right to do it.
Yeah, like if somebody, in retrospect, if somebody came up to you in January of 2007 and say, "Hey, I just sold my company, I have a ton of money, I got to put on the stock market right now,"
Yeah.
you know, in retrospect, was that a good idea? No, because of cycle timing, economic timing, but it was a good time for them with the cash. But I just hope I'm making this clear. Like there are many times where you just have to really take a step back and analyze and make sure you're 100% convinced the timing is right, not necessarily for you, but for the market.
Yeah, that makes a lot of sense. I'm curious, where are you holding the dry powder at? So is that
Yeah.
in what kind of account are you putting that in?
Yeah, I'm annoyed. I'm just on the sideline for so long. So I'm in. What I've been doing is, and I've been doing it since early 2022. Is I've been laddering, meaning buying often at different intervals, short-term treasuries. So what I mean by short-term is, depending on the yields at the time, I've usually focused on 3 to 6 month. I actually elongated that a little last fall when rates were starting to like appear like they were going to go down.
Mhm.
And so I am mostly in 3 to 9 month treasuries right now that I'm just turning as they come up. For someone in California, they're state tax free, I think, and which is advantageous.
Mm.
I'm not happy with a 4 and a change, yield,
Mm.
but it's better than cash in the bank, and
Sure.
it's what I'm most comfortable with right now. So
Yeah. I'm always curious to where people are holding that. And I think that's good insight for people too. To have at least you have something going on, and it's not just the abysmal amount that you be get just sitting in a bank.
yeah, and I actually consider it safer than a money market account. I mean, it depends on how safe you want to be. I think money markets in general are quite safe, but in my opinion, not quite as safe as the treasuries in case there are some bank failures.
Yeah. Well, Jeremy, this has been an amazing conversation. A lot of great insight, a lot of things to unpack. I can't wait to re-listen to the conversation, take some notes and things like that. For the listener who wants to learn more about you and what you're doing, how can people get in touch with you?
Yeah, anyone's welcome to reach out to me. I'm happy to help any way that I can. Also happy to network with anyone who's like, investing, experienced investor, etc. So the best way to reach me is my email, which is jroll, JROLL, at rollinvestments.com with an S. So jroll at rollinvestments.com.
Awesome.
And roll, by the way, I should say it's ROLL investments with an S.com.
Great. Well, Jeremy, thank you so much for being here. Great conversation. I enjoyed having you.
Yeah. Thank you for having me. If anyone is still on here, thanks for hanging in with us. And I hope it was helpful for everyone who listened.
Thank you.